it may raise some eyebrows to go from, because your depreciation is based upon a lot higher allocation than your sales amount.
Hey, Andy, Al, Joe. I have a 2017 Audi A4, a new Husky mix, and I drink bourbon and a lot of it.
That was added for emphasis.
And single malts. In 2007, I purchased a classic Chicago 2-flat, 2-unit building. I renovated the building, made capital improvements to the upstairs unit, which I rent out, and the downstairs unit, which I made my primary residence. The units were equally living. Oh, the units were of equal living area when I purchased the building. Capital improvements of the primary unit, including duplexing the downstairs unit into the basement, adding a master bedroom, master bath, and an additional bedroom. The ratio of living space unit is now 65% primary, 35% rental. Oh my! I just fell asleep.
Go as long as you want, then I'll answer the question. There's a lot here we don't want to read on the air.
Kenneth, this is like
all right,
fix up that house.
Let me take it from here.
Well, I'll finish this.
Okay.
I have carefully kept track of all capital improvements to the rental unit, my primary unit in the common areas, new roof, new back, porch, deck, etc. I've been taking depreciation for the rental, which includes half of the building, original purchase price, capital improvements of the rental unit, and half of the capital improvements to those shared units, shared areas. I purchased the building for $573,000. I made $160,000 in total capital improvements. Rental depreciation to date is $196,000. Assume I now convert my 2-flat into a single-family home this year. My total basis is $569,000. I still $195,000 in depreciation. I wait 2 years, 2024, to sell, assuming $900,000. What are the taxes that I owe? It's like I feel like I'm sitting in a CPA's office.
This is actually
well, you do have one right next to you.
What do I owe? I'm going to take this double unit and turn it into a chicken flat, and then I put some capital improvements on it. Put a little extra bathroom in there.
So when you do this, so you've got a mixed use property, right? So some is rental, some is primary residence. So when you sell that property, then some of it, the residence part, you get the exclusion. You know, you get $250,000 exclusion for selling a property as long as you lived in it and owned it for two out of the last 5 years, right? So I think that's partly what he's trying to do, and that works. And then the rental part. So he's already taken a bunch of depreciation, and depreciation gets recaptured. So that in his text here, the $196,000 of depreciation, then that gets recaptured to the extent of your gain, right? And if we read down further, his profit's 100,000. So only 100,000 gets recaptured. In essence, what you're saying is you lost $90,000 on your property, which only occurred because you originally called it 50-50. Now you're calling it 35-65. So your ratio's off. It may raise some eyebrows to go from, because your depreciation is based upon a lot higher allocation than your sales amount, which is what you'd want to do if you're trying to get that home exclusion, trying to get more gain deferred. But I think you may have a little bit of issue here.
So let me break this down for the simple man.
Yeah, please.
Okay. So he bought a multi-use property, rented one area, lived in the other. When he purchased it, let's call it $500,000.
Yeah.
Okay. So he's going to say half of this I'm going to rent out, half of it I'm going to live in. I bought it for 500. So we're going to split it 250 basis for each. And that's what he started with, basis 50-50.
That's right.
250 for my primary, 250 for the rental. But what I did is that I did a lot of improvements to my primary. I put in another bathroom. I did this and I did some extra stuff here. So I think it's probably worth more. So now I want to change my ratio when I sell it to 60-40 or 70-30.
Yeah, that's what he's doing.
Right. Because if I sell and then he wants to sell it for $1 million, and let's just assume there's a total of $500,000 of gain. And if I split that 50-50, 250 would go to the primary, 250 would go to the rental.
Right.
Right. And then plus depreciation recapture, whatever he recaptured.
Yeah. So the rental gain would be higher, right? Because you got depreciation recapture.
So because I lived in the house 2 out of the last 5 years, I get the 121 tax exclusion, which allows me to exclude 250,000 of gain or 500,000 of gain if I'm married or single. So maybe he's single and he's like, you know what? I got 250 tax free coming to me because I've lived in the primary 2 out of the last 5 years. But you know what? I want to maybe I'm married and I want more of that exclusion because I can exclude up to 500,000. So I'm going to flip my ratios a little bit and have more gain on the primary than on the rental.
Yeah, you got it right.
And so now I could say, you know what? 60% of that $500,000 gain is on my primary, which is going to get wiped out because I get the 121 tax exclusion. I'll pay my depreciation recapture, and then I'll pay whatever gain is on the 40% or 30% of the rental.
That's what he's doing. But here's the smell test. So the smell test is he made money on his residence and he lost money on the rental, same property. That's why I'm having a little trouble with these numbers.
So,
And that happened because of the ratio changing.
right. So it started at 50-50, and now all of a sudden you're tweaking the ratios here. But he could say, well, look at the rental's a piece of, whatever. I didn't do anything to it, but look at my primary, look at all the,
You could, but that's the question. And actually the truth is in his numbers, he's making profits on both. It's just that when you add back the depreciation, he's losing 100,000 on the rental, which probably isn't likely.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.